Hi, we're starting chapter 5. We'll talk about merchandise inventory. Every chapter we discussed before, it was all about service companies. We never discussed a company that buys inventory and sell it, make business out of it. We always discussed companies who provide a service and get paid for it. In other words, service companies, they do not have an input, they just have an output. But merchandise companies such as retailers, wholesalers, they have to buy inventory to sell it, and that's how they make business. Now, when it comes to accounting and recording journal entries and some of the accounts that we use for merchandise companies, it's a little bit different. We've got more accounts to use for merchandise companies. So, first of all, we need to know that there are two inventory systems that company has to choose from. Every company has to choose from. There's the perpetual inventory system, and there's the periodic inventory system. A lot of companies these days are using the perpetual, and that would be our main focus in our videos for this chapter. Let's talk about the first journal entry that a company has to record when they purchase inventory under the perpetual inventory system. So we go step by step in our transactions and recordings. The first example is purchasing inventory for cash. So the name of the account that we will use for inventory, which is going to be an asset account, it's called merchandise inventory. Okay, I'm going to use that side to write down all the accounts, the new accounts that we're going to use for chapter 5 that we didn't see before, and some other notes as well. I'll use that space for it. So purchasing inventory for cash, it's an asset, so it increases with a debit. So we will say debit merchandise inventory. And let's say that was $10,000, and then we paid cash. So cash out of the pocket, that will be credit because an asset decreases with a credit. So that will be a credit to $10,000 for cash. If we purchase the inventory on account or on credit, which means that we're going to purchase it today, we're going to receive the inventory today, but we will pay for it in future. That means we will be liable to pay some cash in future. That will be accounts payable that needs to be used in our journal. So purchasing an account, we still have to debit merchandise inventory because we received it. It became one of our belongings, which makes it an asset. So merchandise inventory will be debited for $10,000, but the credit is going to be different from the first one. This time it's going to be accounts payable, $10,000. Okay. And the other thing we need to talk about is discounts. So when you get a discount when you purchase inventory from your supplier, and the type of discount we're going to talk about today, it's not a promotional discount that like the one we get when we go and buy anything from the market that has a promotional discount on it. It's a discount for paying early. So for example, let's say that our supplier gives us 30 days to pay for the inventory that we received today, all right? And let's say that that supplier will give us 2%, for example, 2% discount if we pay after 10 days, not 30 days. So they give us 30 days, it's okay to pay on day 29 or day 30, but if we pay on day 9 or 10, they will give us 2% discount just because they want to motivate us to pay early. So on the invoice, they will write these terms on the invoice, 2/10 n/30. And then this is just an example. It might be 3/10 or 2/15. And what that means is we will get 2% discount. So that number means the percentage of the discount or the discount rate. And that is the number of days they give us for the number of days they give us for a discount period. And then n/30 means net. That means we have to pay the net amount. if we pay between day 11 and day 30. Okay, so we get up to 30 days, but if we pay within the first 10 days, we get 2% discount. So let's say that we purchased the inventory for $10,000. We're going to record the whole amount, even if we're planning to pay within the discount period and get discount in future. The day we buy it, because we don't know yet that we're going to get a discount, so we have to record the full amount. And then later on, when you go back and pay, if you got a discount, then you will consider your discount in your journal entry. So we're not going to consider any discount when we purchased it. When we purchased it here, but we will consider it only with the day we pay. So let's say we paid for that inventory on day 9. We get 2% discount. At that time, so it was merchandise inventory, accounts payable 10,000, and the day we paid for it, our accounts payable has to decrease, so that will be a debit to accounts payable, because if you paid for it, then you don't owe them money anymore, so the accounts payable has to decrease. Decreasing a liability is always a debit, okay? And then we're gonna decrease it by the full amount, and then in your credit side, you're gonna pay cash, so that will be cash. And then how much cash are we gonna pay? Well, we will pay less than 10,000 because we got 2% discount. So 2% of $10,000, that would be $200. So we will pay 10,000 minus 200, which is $9,800. Okay, and the difference will be the discount, which is 200. Remember that your total credits has to equal your total debits every time. Okay, so you will have $200 discount, and the name of the account that we will use for the discount is also the merchandise inventory. Okay, we're not going to say discount or anything like that, so we will just use that same account. Okay, now someone might think, why do we have to decrease the merchandise inventory? If I'm crediting merchandise inventory, that means I'm decreasing it. Well, remember that we're not decreasing the quantity for the merchandise inventory, we're just decreasing the cost of that merchandise inventory. Okay, we're decreasing it by $200. So if we go back to, so those are the two journals that are linked to each other, I would say. That's the day we paid for it, we purchased it, and that's the day we paid for it, okay? So the T account for merchandise inventory, it used to be $10,000 debit, and now that I'm crediting $200, that makes my ending balance $9,800 for the merchandise inventory. That means that the merchandise inventory costed me $9,800, not $10,000. And that's true because we got $200 discount. So remember, I'm not decreasing the quantity. I'm not saying that I sold one of them or I returned one of them. I'm just saying that I'm decreasing the cost by $200. Okay? All right, so remember that accounts payable has to decrease by the full amount because initially we did $10,000 to accounts payable. So when I decrease it, it has to decrease by $10,000, the full amount. But then in your credit side, here you will have less than $10,000 for cash. It will be $98,000 because that's what we actually paid. And the difference goes to merchandise inventory, which is the discount, to reflect the discount. Okay, one more example. So what if we decided to return some of that inventory to the supplier? Okay, so remember that we got a discount. Don't forget that. We're going to return, let's say, $1,000 of inventory to the supplier, and then let's say that the supplier will give us cash back, but we also have to consider that the cash back will be less the discount. Okay, so purchase returns and allowances, it's going to we're going to return inventory, so that will make our inventory decrease, which is going to be credit. And then the debit side, it will be cash because we already paid for it. Okay, so that will be cash for remember, it was $1,000 of inventory. We got 2% discount on that, so that has to be returned. Take 2% of 1,000, that will be $980. So the cash back will be $980. And then your credit will be merchandise inventory for $980 as well. So my merchandise inventory will decrease by 980. Two more examples for purchasing inventory. We just recorded purchase returns and allowances, which is after we paid already. And then I'm gonna take another example for returning inventory, but this time it's before we paid for it. Okay, so this time we're not gonna get cash back because we didn't pay for it yet. Instead, we will decrease what we owe to the supplier because we after returning the items we will owe less money now. So instead of getting cash back, we would just have to decrease the accounts payable. So purchase returns and allowances, let's say it was $1,000 of inventory that we're returning. Then again, we have to decrease accounts payable. That will be $1,000. It's not going to include any discount yet because as we know, the discount will only show up the day we pay. If I didn't pay for it yet, in our example here, that means the accounts payable is going to decrease by the full amount, and it's going to be the $1,000. It's not $1,000 minus discount. And then the credit will be merchandise inventory because that has to decrease by $1,000. The other thing that we need to consider is the transportation. There are two type of transportation in a way how we deal with transportation. There's FOB destination and there's FOB shipping point. The main difference between them, we as buyers, the FOB destination means that the supplier, the company that we're purchasing from, is responsible to transfer the inventory to our place. So it's destination from their point of view. It means our place is their destination. So we don't have to be worried about paying for transportation, and we don't have to be responsible for anything happens to the inventory while it's being shipped to us. The other type is FOB shipping point, which is from the seller's point of view, it's their own place, it's their warehouse. So if it is FOB shipping point, we as buyers, we're responsible to go to their place and collect the inventory, and we are responsible to ship it to our place. Plus that if there will be any transportation cost, we will be responsible to pay for that. So keep in mind, as buyers, we only have to pay for transportation if it is FOB shipping point. Okay, so let's consider that it was a shipping point, FOB, and it was $500 of shipping cost. That cost will be added to the merchandise inventory itself. We're not gonna create an expense account for that. We have to capitalize that cost. It means we're gonna add it to the cost of the inventory itself. Just like when you buy a textbook on Amazon, for example, and you pay $100 for that, but Amazon charges you $5 for shipping to your house. And then if I ask you how much you paid for the book, you will say it cost me $105. You're not gonna say 100 because the $5 shipping cost was part of the deal, part of the cost. Okay, so we just consider the shipping cost part of the inventory. So I will debit the merchandise inventory because I'm gonna add the $500 shipping cost to the inventory itself. So the inventory will increase, not the quantity will increase, it's the cost of that inventory will increase. And then the credit will be, depends if it is on account or if it is cash deal. Let's say that we just paid for it on spot the day we received it and the day we shipped it, I mean. So that would be credit to cash because cash out of pocket is credit, $500. Those are the examples for the purchases when we purchase the inventory under the perpetual inventory system. It will be different when we do the periodic system. We'll do that later. In the next video, we will talk about selling the inventory. Everything we did in this video, it was related to purchasing it. So we were the buyers. And now in the next video, we'll start being, we will talk about sales. So we will be the seller. Okay, the journals will be different. So you always have to make sure before you start thinking about the journal entry for merchandise companies, you always have to think if you are the buyer or the seller before you think about the journal. It's so much different.